What's going on? Welcome back. Ryan here. In this video, we are talking about option Greeks. Now, if you haven't heard this term, or maybe you have, option Greeks are variables represented by Greek letters that describe the way an option price moves in relation to the underlying asset. So, option Greeks, let's get into this. I have this little slide here, and these are the option Greeks, right? So we have delta, which is an amount an option price will move based on a $1 move in the underlying asset's price, right? So delta tells us how this option price is going to change when the price of the underlying asset fluctuates, right? Gamma is the rate of change in delta for every $1 move in the underlying asset price. So gamma is like the delta of delta, right? So when the option price changes, right, delta is going to show us how that's going to happen, and gamma is going to show us how that delta is going to change, okay? Third is theta, right? Theta decay's effect on value of an option's price, which is the time decay, right? Theta represents how much this option's price is going to decay over time, right? Because remember, options are depreciating assets, right? Over time, their value decreases as it approaches that expiration date. Vega is the amount an option's price will change based on a 1% move in the underlying asset's implied volatility, right? So when markets start to become very volatile and they could have huge moves, right? Huge swings in the prices, Vega is going to change the way this option responds to that 1% move in the implied volatility. Okay, and finally is rho, an options price's sensitivity to changes in interest rates, and we're going to go through these in a little bit of detail here. So let's talk about delta first, right? So delta is a number between 1 and -1. Calls are positive and puts are negative, okay? Delta can be thought of as an approximation of the probability of an option ending in the money. So for example, a delta 40 call option could be thought to have approximately 40% chance of ending in the money, or an approximately 60% chance of ending out of the money. Right, so if we just go into our trade tab here and we bring up Apple and we open up one of these option series here, and what we do is if we change this to see these delta, gamma, theta, vega, right, rho is not so much looked at because the short-term option prices are not affected that much, but the most important ones, right, are the delta, the gamma, the theta, and the vega, right? So if we look at this at the money call option, right, 31 days to expiration, let's look at the 175 call, right, on Apple. We can see that it has a delta of 41. So looking here, if it has a delta of 41, we're basically saying that this option has a 41% chance of ending up in the money, or it has a 59% chance of ending out of the money. Okay, now delta can also be looked at as the relative share numbers, right? Remember that option contracts on stocks represent 100 shares of the underlying stock, right? So an option that has a delta of 80 could represent 80 shares of the underlying stock. And this is easily represented by looking at this option chain, and again, looking at this 175 call, and we look at this 41 delta here. And this could represent 41 shares of the underlying stock, right? And the way that we figure that out is this. As the stock moves higher, right? As it moves higher, and as this delta approaches 1, right? Because we can see these option contracts that are in the money, very deep in the money, all of these deltas are approaching 1, right? Because they're all approaching, acting like 100 shares, right? Because if you were to exercise this call option in the money for its intrinsic value, you would have, 100 shares, right? So important to take note of these numbers, right? Delta can be a highly valuable and quick way to make approximations when we're looking at options and thinking of what we can do, right? So delta represents how an options price will move relative to a $1 move in the underlying asset. So if you own a Delta 50 call on Apple that you paid a premium of $5 for at a strike price of $200 and Apple is trading at $198, if Apple moves to $199, which is a $1 move, the option price would then be $550, right? Because the option price is going to move up by that delta number. Okay, so moving on, gamma. Remember, gamma is the rate at which delta changes. So the delta of delta. Gamma shows how much delta will change given a $1 move in the underlying asset. This is known as the acceleration of delta. All right, so for example, if you have a call option that is a 20 delta and has a premium of $1, and that option has a gamma of 0.10, if the underlying moves $1, the option price will now be at 120, right? So the premium of 20 plus our 20 delta gives us now a premium of $1.20, and the delta would then have a value of 0.3, right? Because gamma would increase that delta by 0.10, and now maybe the gamma has increased to 0.15, right? So if the underlying moves another $1, the option would then have a premium of $1.50, right? Which would be the previous premium plus the new delta would give us this $1.50 premium, and then the delta would change to 0.45, which would be the last gamma that's added to the delta, right? So you can see that gamma is showing us how fast delta can accelerate. Now, if we come in here to the options chain, right, these numbers are quite different, right? So with 31 days out, we can see that a delta of 41 here has a gamma of 0.03, right? So if Apple moves up $1, right? If it goes from 169.75 to 170.75, that dollar increase is going to add $41 to this option price, and this delta is going to increase by $3, right? So obviously the numbers are over exaggerated in the example on the slide, but when we come in here and we look at the actual options chain, we can see exactly what this information means, and we can use that to help us make better decisions. Okay, so looking at theta, right? Theta represents the time decay of an options premium. Remember, options are depreciating assets. Options lose value from the passage of time. As time moves forward, the premium of an options price decays exponentially until there is none left and it either expires worthless or with intrinsic value. Theta represents the amount that an options premium will decay each day. So for example, an option with a theta value of negative 0.20 will lose 20 cents a day or $20 a day on 100 shares. Okay, so when we come in here and we look at, for instance, that same $175 strike call, right, that had the delta of 0.41 and the gamma of 0.03, we can see that this options price is decaying at $9 a day, right? So if you bought this option and the underlying asset didn't move, you would be losing about $9 a day on the price of this option. So theta, right, is always negative for options we own, right? Because if we own this option, we have put money up for that premium as the buyer of the option, right? We're buying the right, but not the obligation to do something. And the value is negative because it's losing time, and we're going to experience that loss if we purchase these options. Now, if we sell the options, right, the theta value is actually positive because this decaying value is money that we keep, right? So theta accelerates as time moves forward. The farther away from expiration, the smaller the theta decay. Okay, so, and again, options that are farther away from the money tend to have thetas that decrease. Same for delta and gamma, okay? And last but not least, so another slide that I wanted to put up. This is a common graph that you'll see as a representation of theta, right? Where on the bottom here, we have time remaining until expiration, right? 120 days, 90 days, 60 days, 30 days, and 0 days. And here we have the options value, right? So we can see that if we use, there's calculus equations that represent the area underneath this curve, right? But as the passage of time happens, the options value decays, right? And as we approach the 0 days, the slope of this is ever increasing, right? Until there's nothing left, right? So this is a really key concept to understand, especially for people who are just starting, or maybe you're already trading and you're losing, and maybe you have had the experience of buying options that are under 30 days to expiration, and maybe the market doesn't move as much, or maybe the market does move, but it just doesn't move fast enough, and the rate that the option is decaying is greater than the delta is changing in your favor, right? So this is where people really mess up. They tend to buy these really short options, right, with almost no time, and they end up putting a lot of money into them, right? We see this a lot on Wall Street bets, right? People YOLOing their life savings into these options with little to no time value, and then they lose massive amounts of money. And, I'm not sure if they understand why that's happening, or maybe they don't care, but the idea here is not to lose money, right? The idea is to make money. And this is a key concept, right? Because if we're going to play in this last little area here between 30 days and 0 days, where the slope of the tangent to this line, right? What's the slope of any point on this line, right? Which would be the tangent. If we're looking at math, we want to be selling those options, or at least having some exposure to theta decay that can be on our side, right? Either using calendar spreads, butterflies, other strategies that we make money through the passage of time, right? So this is a really important concept, if not one of the most important concepts to understand when you're trading options, okay? Now, next is Vega, right? So Vega represents how an options price will move in relation to a 1% move in the underlying asset's implied volatility, right? So a 1% increase in the options implied volatility will increase this premium by $20, right? So if the increase in implied volatility of Apple was $10, or sorry, 10%, if the implied volatility went up 10%, this option price would go up $200. Okay, so just understand that delta, gamma, theta, vega, these are important metrics that we can use to not only select options that we buy, but information that we can use to make adjustments, change things when things don't go our way, and especially this theta, right? This graph here, this is a very important concept, which I'm going to continue to drill into your mind because I know it's going to make a difference in your results, right? And everybody wants to have massive results quickly, and this is a key component to understanding where you're going to lose money when you're trading, okay? So last but not least is rho, and rho represents how an options price will change in relation to a 1% move in interest rates. Again, rho, they don't even have it here. I'm not sure if I could customize this and bring it up. I might be able to. Yep, here it is. So there is rho, but we're not going to look at it because it's not that big of a factor when it comes to short-term option prices. It can have an effect for longer-term options, but maybe when we look at some longer-term strategies, we could talk about that. But for now, just know that rho exists, and again, the most important thing is probably the delta, right? Delta, gamma, theta, and vega. I highly, a lot of people, some people don't think that these things matter. Some people really think they matter. I think that they can be good metrics to look at when we're thinking about strategies and different option deltas that we can target for different things. But it's still important to understand what these mean, because it's just giving you more tools and more information to make solid decisions. Okay, so again, super thrilled you're here learning with me. It's so awesome that you are investing into yourself. I know this is going to help you, especially understanding theta decay, and that the majority of option traders are losing because they don't quite understand just how sensitive option prices can be when you're buying options and time is ticking away and underlying assets are maybe not moving as much as you think they are. But this is a super important concept to understand, and I'm going to keep drilling it into your head. So again, I'm excited to talk to you in this next video, and I will see you there.